Welcome to the Downlight Down and Feather Market Update. It's July 2026, and we're back with your monthly breakdown of everything happening in the global down and feather market. Before we get started, a quick announcement for you all. On September 24th, we're going to be covering our next webinar. We're going to be covering how to care for your down, covering the best ways to take care of it, store it, and clean all of your favorite down products, from garments to sleeping bags to pillows and even bedding. We also have a quick compliance reminder. Today's report is based on the latest market metrics and our best interpretation of current conditions. It shouldn't be viewed as a financial forecast or a guarantee. Always weigh all available information before making final business decisions. With that out of the way, let's get right to the headline news, because we have a shift from what we saw last month. From early June to early July, basic down shipping ex-works from China actually saw some welcome relief. Basic duck down decreased by about 5.2%, and basic goose down dropped by 5.1%. However, keep in mind, those figures are before factoring in any tariff costs. Let's head over to China and see what's driving this pivot over there. After a period of rapid price hikes during the first half of the year, the Chinese market has softened modestly, several suppliers reporting price declines of around 3 to 5%. The main drivers behind this dip are typical summer demand softness, apparel brands delaying their purchases, and suppliers liquidating inventory right after the massive 618 shopping festival. Don't mistake this for a total market reversal, however. Transaction activity has slowed, but suppliers emphasize that the brand orders are simply delayed, not canceled. They expect buyers to return as autumn and winter production ramps up, a relationship we're going to be watching closely here at Downlight. Fundamentally, the baseline hasn't changed, with raw material availability remaining heavily constrained as duck and goose breeding volumes are still declining, inventories are well below normal levels, and poor poultry economics continue to discourage farmers from expanding. We're also seeing the market segmentation widening even further. Premium and outdoor apparel, high fill power, goose down, and export markets are staying relatively healthy, while lower and mid-tier consumer segments are dealing with weaker demand. Now let's check in on the Chinese pork market, which we've been tracking closely for its spillover effects on poultry farming. After long financial losses, pork producers are finally reducing breeding capacity, and government efforts to control overcapacity are actually taking effect. This is leading farmers to send fewer hogs to slaughter, anticipating better prices in the future. Consequently, this is leading to a gradual recovery in the broader pork market. First week of July, China's Ministry of Agriculture reported that live hog prices climbed 4.2% week over week, while retail pork prices edged up roughly 1%. So what does this mean for down and feather supply? Right now, not much. Duck and goose meat economics are still incredibly challenging, and suppliers are continuing to report low inventories. While a recovering pork market could eventually help broader poultry farming, experts say that it will take 4 to 8 months for any increase in duck and goose production to translate into more raw feather and down availability. For now, tight supply remains the main floor supporting long-firm prices. Now let's take a look over across the Atlantic to Europe, where the story is completely different. The market there remains exceptionally tight, and we aren't seeing much of the relief that participants hoped for. Raw material availability is falling even as the summer collection season arrives. Inventories are so depleted that multiple European suppliers are completely out of stock and are pausing new quotes until the next round of material is collected. Demand for original duck and goose material remains intense as well, with Asian processors continuing to buy supply directly from European slaughterhouses. At the same time, manufacturers who put off buying earlier in the year are actually forced to return to the market now to meet their strict production schedules despite historically high prices. We're also watching a long-term structural shift take hold in Europe, with stricter environmental regulations, climbing compliance costs, and a push for fully traceable supply chains rewriting the rules. Interest in recycled down is accelerating, while premium, high-fill power goose down remains dominant in luxury bedding and high-end outdoor gear. Suppliers see zero signs that European pricing pressures are going to ease up anytime soon. To wrap things up, let's take a look at the macro forces impacting your bottom line, shipping lanes, trade policy, and exchange rates. First up, ocean freight. Route from China to the United States, container volumes cost around $6,500 to $7,000, excluding inland transit costs. Rates from China to the United States have continued to climb since the start of June. Peak season demand is building, carriers are tightly managing vessel capacity, and higher fuel costs paired with the Middle East geopolitical uncertainty are keeping costs elevated. On the flip side, freight rates from Europe to the United States have remained comparatively stable, with plenty of capacity available across the North Atlantic. On the tariff front, thankfully things remain stable here as well. The broader US-China trade relationship is holding steady as both nations implement the framework agreement established in June, which includes China resuming rare earth exports and the US easing certain export restrictions. The baseline tariff rate has also remained unchanged, with China, Vietnam, and Taiwan still sitting at 10% and Europe sitting at around 10%. 5% as well. Crucially, the Section 301 tariff exclusion for qualifying down and feather imports from China remains fully valid through November 10th, 2026, saving US buyers that extra 7.5% duty for now. We're also keeping a close eye on the USTR, which has launched new Section 301 investigations into forced labor and industrial overcapacity. China is included in these proposals, but nothing has been implemented as of yet. Finally, let's look at the currency matchup since early June. The USD versus Chinese RMB. The US dollar gained against the Chinese RMB, moving from 6.77 up to 6.80. This shift was triggered by a stronger US dollar and geopolitical uncertainty. There's also expectations of higher US interest rates that are also driving this push as well. Meanwhile, the dollar also strengthened modestly against the euro, moving from 0.87 to the 0.88 range, backed by solid US economic performance and slower growth across parts of the Eurozone. Bringing everything together, the global market is experiencing a bit of regional divergence. Europe is still in an extreme supply crunch with record high pricing, while China is seeing a temporary summer softening due to seasonal buying patterns and delayed brand orders. Most suppliers view July as a brief pause rather than a true market reversal. The core fundamentals, low global inventories and restricted breeding volumes, are expected to keep supporting prices firm over the medium to long term once seasonal ordering picks back up later in Q3. Some downside risks to watch are weaker than expected global consumer demand, extended delays in brand purchasing decisions, and potential for a milder northern hemisphere winter. And while those downside risks could place downward pressure on prices later this year, suppliers believe that tight supply constraints will continue to outweigh those factors for the foreseeable future. But that's your update for July 2026. We'll continue monitoring the data as the summer unfolds. If you have any questions on how these shifts affect your specific sourcing programs, leave a comment down below or get in touch with our team directly. Thanks for watching the Downlight Market Update. We'll see you guys next month.